Buyers' cancellation in Los Angeles area's escrows are one of the highest rates we've seen in years. And here's what most sellers get wrong. They assume the buyer changed their mind because of price, or got cold feet after inspection, or they just decided they do not want to move forward. The actual data tells completely different story. In 2026, there are 3 very specific reasons buyers are backing out of escrow in Los Angeles market, and none of them is what most sellers expect. You're about to list your home, and when you're ready to go into escrow right now, you need to know what these are so you can protect yourself before it happens to you. My name is Rima Rafeh with the Rafeh Group here with eXp Realty in Santa Clarita Valley. I've been selling real estate for over decades, and I work with sellers every single day. And what I'm seeing in 2026 is a pattern of escrow failure that is catching sellers completely off guard because of the reasons are not the ones anyone prepared them for. So let's get into it. Before I tell you the 3 real reasons, I want to quickly address the ones everyone assumes. Yes, buyers sometimes back out because of inspection findings, structural issue, a roof at the end of its life, or HVAC system that needs replacements. Those happen, and they have always happened. Yes, buyers sometimes get cold feet. They get into escrow, and the emotional reality at the commitment sets in, and they decide they are not ready. That happens too. And yes, occasionally buyers' financial situation changes mid-escrow. A job loss, a change in that situation, something that affects their ability to qualify for the loan. Those are reasons sellers brace for. Those are reasons agents talk about, but they are not what is driving the elevated cancellation rate in Los Angeles County now. What is driving this right now is a set of 3 forces that there are specific to this market, specific to this moment, and that most sellers are honestly, many agents are completely unprepared for. The first reason home buyers are backing out of California escrows in 2026 is homeowners insurance. And if you do not understand the full picture of what is happening in California insurance right now, this reason is going to shock you. Let me give you the data. According to the Stanford University Climate and Energy Policy Program, average California homeowners insurance premiums rose 84% between end of 2020 and March of 2026. 84%, that is not a typo. Since 2022, 7 of California's 12 largest home insurance have limited new home insurance policy or withdrawn renewals on the state entirely. State Farm, California's largest home insurer, has paid $1.26 in claims for every $1 in premium collected over the last 9 years, resulting in $5 billion in cumulative losses. Allstate has pulled back significantly. Multiple major carriers have stopped writing new policies in high-risk areas entirely. The result is that for growing numbers of California buyers, finding affordable homeowners insurance has become the single most stressful and unpredictable part of the entire home purchase, and is now happening after they are already in escrow. Let me explain why this matters so much. In the Los Angeles market, Santa Clarita, and California in general, mortgage lenders universally require proof of adequate homeowners insurance before they will wire closing funds. No insurance binder and no closing is that simple. And what's happening right now is that the buyers are going into escrow with the home they love at a price they negotiated and agreed to, with financing they have already been approved for. And then during the escrow period, they discovered that they cannot get homeowner insurance on the property at the price that they can afford, or in some areas they cannot get it at all. In certain parts of Los Angeles area and Santa Clarita Valley, hillside and canyon communities in the wildland urban interface zones that cover significant portions of Southern California, buyers are being quoted tens of thousands of dollars, $12,000, $15,000 or more per year for basic home insurance on a home where the previous owner was paying $2,000 or $3,000 a year. When that premium hits a buyer's monthly payment calculation at that magnitude, it changes their debt to income ratio. It changes their ability to qualify for the loan. And it changes the entire financial picture of the purchase. And in some cases, it makes the transaction simply unworkable. According to the data tracked real estate analysis, insurance-related transaction cancellation in California nearly doubled between 2023 and 2024. And the insurance situation in California has gotten significantly worse since then, not better. After devastating January 25 Palisades fire, insurers faced an estimated $40 billion in claims and responded by pulling even further from California. The California FAIR Plan, the state insurer of last resort, now covers approximately 5% of California's single-family homes, up from 0.5% in 2020. Here's what sellers need to understand about the situation. It's not just happening in the fire zones everyone expects. According to data tracked by real estate analysts, insurance-related transactions cancellation in California nearly doubled between 2023 and 2024. And the insurance situation in California has gotten significantly worse since then, not better. After the devastating January 2025 Palisades fire, insureds faced an estimate $40 billion in claims and responded by pulling back even further from the California market. The California FAIR Plan, the state's insurers of last resort, now covers approximately 5% of California's single-family homes, up from 1.5% in 2020. And the FAIR Plan has filled for nearly 36% rate increase to cover the cost of wildfire claims. Here's what sellers need to understand about the situation. It's not just happening in the fire zone everyone expects. Stanford researchers have found that dependence on the FAIR Plan is now showing up in moderate and low wildfire risk zip codes as twice the rate as its overall market share. The problem has spread beyond Fire County into the broader California housing market. And that means buyers in areas that sellers have never thought of as high insurance risk as now encountering insurance complications that they are derailing closings. One local agent captured this perfectly when he said, "I've had clients call me on inspection day devastated that no insurer will touch their house." That's not happening in isolated cases. That is becoming a pattern. And if you are a seller who's not proactively addressing the insurance question before or during your listing process, you are setting yourself to have a deal collapse at the worst possible moment when you thought you were 30 days from closing. So what do you do about it as a seller? You get ahead of it. Before you list, you and your agent should be researching the insurance landscape of your specific property. What carriers are writing policies in your area? What are the approximate premium ranges? Are there mitigation factor, defensible space, fire-resistant roofing, amber-resistant vents? That could help a buyer qualify for better rates or unlock mandatory discounts under California AB 2167. The more information you can proactively provide the buyers about the insurance landscape of your specific home, the less likely you are to have a buyer discover an insurance problem in a week 3 or 4 of escrow and cancel because they have no idea what was coming. In some cases, particularly for sellers in high fire risk area, it may be worth proactively getting an insurance quote yourself before listing. So you have a real number to share with buyers so there's no surprises mid-transaction. A seller who walks into that conversation informed and prepared is a completely different position than one who finds out about the insurance crisis the same time their buyers does. The second reason buyers are backing out of California escrows in 2026 is the appraisal gap. And this one is causing significant disruption, specifically in markets where prices have been rising faster than the data used by appraisers can keep up with. So here's how the appraisal process works. When a buyer gets a mortgage, the lender orders an independent appraisal for property. The appraiser's job is to determine the fair market value of the home based on comparable recent sales. The lender will only loan based on that appraisal value. If the home appraises for less than agreed upon the purchase, what the industry call an appraisal gap, the buyer lender will not cover the difference. The buyer has to make up that gap in cash. The seller has to lower the price or one of them has to walk away. And in 2026, the appraisal gap problem has become more frequent and more complicated for a specific set of reasons. Appraisals by nature rely on historical data, closed sales from the past 90 to 180 days in most cases, in a market where prices have been moving. We're where specific neighborhoods are seeing demand that recent sales data does not fully reflect, or where a home has a unique characteristics that comparable sales do not capture. The appraisal can come below what is motivated buyer was willing to pay. And when that happens, the math of the transaction changes immediately. So let's take a look at this. A buyer agrees to purchase a home in Santa Clarita Valley, for example, for $850,000. They put down 20%, which is $170,000. The lender finances $680,000. The appraiser come in at $40,000 below the purchase price. The lender will now only finance $648,000, the 80% of the $810,000 appraised value, and the buyer either has to come with an additional $40,000 in cash to cover the cap, or the seller has to reduce the price by $40,000, or the deal has to be renegotiated or canceled. In a competitive market environment of recent years, many buyers were waiving appraisal contingencies entirely to make their offers more attractive. But as the market has shifted and buyers have more choices, as inventory has increased and the frantic bidding war of 2021-2022 have become less common, buyers reinstating their appraisal contingency. They are protecting themselves, and when those contingencies are in place and the appraisal comes in low, buyers have full legal right to cancel and recover their deposit. What sellers need to understand is that the appraisal outcome is not just about the price they agreed to with buyer. It's about whether the historical comparable sales in the market can support that price. If you are priced the absolute ceiling of your neighborhood recent sale data, even if a motivated buyer willing to pay it, the appraisal may not agree. And that disagreement creates a gap that has to be resolved one way or another before the transaction closes. The best protection a seller has against an appraisal problem is pricing accurately from the beginning, not at the ceiling, at the strategic price the market data can support. An experienced agent who understands how appraisers think, what comparables they will use, and where the ceilings of supportable value actually sits in your specific market is one of the most valuable things you can have working in your corner before you even accept an offer. The third reason buyers are backing out of California escrows here in the Los Angeles area, Santa Clarita in 2026 is one that almost no seller expects and almost no agent talks about, and that it has already caused a problem. It's the rate lock expiration issue, and it's costing sellers transactions that were essentially done. Here's what rate lock is and what it's. When a buyer gets approved for a mortgage, their lender gives them a rate lock, a guarantee that interest rate they were quoted will be honored for a specific period of time. Standard rate locks are typically 30 to 45 days. Some are 60 days. The rate lock covers that expected escrow period and gives the buyer certainty that their mortgage payment will be what they budgeted for when they made the offer. Now, here's what starts creating problems. If an escrow takes longer than expected because of delays in paperwork, because of repairs, negotiation that extends back and forth, or because of solar lease transfer taking too long, because of appraisal came back low and has to be contested, or for many other options, common option in 2026, they were. Now here where it starts creating problems. If an escrow takes longer than expected because of delays in paperwork, repair, negotiation that extends back and forth, or because of solar lease that's taken more than 30 days, or because of appraisal came in low and now we have to negotiate, or because of any numbers of friction points that are far more common in 2026 than they were 3 or 4 years ago. The buyer's rate lock can expire before the transaction closes. And when rate lock expires, the buyer has either pay a fee to extend it, sometimes hundreds of thousands of dollars, depending on where the lender, or they lose the lock rate entirely. And they have to relock at current market rates. In an environment where mortgage rates are sitting around 6.5% after rising from the 6% range earlier this year due to the inflationary pressure from the current, and in an environment where mortgage rates are sitting at around 6.5% after rising from the 6% range earlier this year due to inflationary pressure from the current geopolitical environment, even a 1/4 percentage point increase in their rate meaningfully changes the buyer's monthly payment and sometimes their ability to qualify for the loan amount they were approved for. So let me put real numbers on this. A buyer lock at 6.1% on a $680,000 loan has a principal and interest payment of approximately 4.25%. Let me put real numbers on this. A buyer lock at 6.1% on $680,000 loan has a principal and interest payment of approximately $125 a month. If their lock expires and they relock at 6.5%, that same loan now costs approximately $4.29 per month. That is $174 more every single month over 30 years. That's more than $62,000. And if that $174 monthly increase pushes their debt to income ratio above the lender's threshold, the loan may not be approved at all. This is not hypothetical. This is happening, and in many cases, the rate lock expiration is not the buyer's fault or the seller's fault. It's cumulative results of every delay that added up across the 40 or 60-day escrow period in a market where escrow friction has increased significantly. The solar complication added 10 days, the inspection negotiation took another 8 days, the appraisal came in low, and now we have another at 7 days, and suddenly 30-day rate lock is starting down transaction that has taken 55 days plus, and the buyer is faced with a cost that was not in their budget when they made the offer. So what sellers can do about this? The answer is managing the transaction timeline with discipline and intention from day one. Every delay in an escrow has a cost, and in 2026, that cost is increasingly being measured on rate lock extension and recalculation that fall onto the buyer. An experienced agent who manages the transaction timeline proactively, who pushes contingency removal on schedule, also follows up with escrow and the lender consistently, who identifies potential delays early and addresses them before they compound, is the difference between a smooth close and a collapsed deal in the final week when everyone thought they were done. Now let me pull all these three things together because I want you to see the bigger picture of what is actually happening in this market and why it matters so much for how you approach your listing. The escrow cancellation problem in LA area in 2026 is fundamentally a problem of complexity. The transaction environment has more moving parts, more potential friction points, and more external variable than it has in generation. Insurance is no longer a form you fill out 2 days before closing. It's significant financial variable that has to be addressed early in the process. Appraisals are no longer formality that rubber stamps the agreed price. They are independent evaluation that can reset the entire financial structure of the deal. Rate locks are no longer a protection that lasts comfortably through any standard escrow timeline. They are countdown that starts the moment an offer is accepted. And here's the thing that connects all three of these issues. None of them are things a buyer can fully control once they are in escrow. They are largely driven by market forces, the insurance crisis, the appraisal data landscape, the interest rate environment that exist independently for any individual transaction. What a seller can control is how prepared they are for each of these variables and how skilled the real estate agent is at navigating them before they become deal killers. The seller who closes smoothly in these markets are not lucky. They are prepared and they know the insurance landscape for their property for the first showing. They are priced at a number the appraisal data can support. And their agent manages the transaction in a timely, like a project manager, not a passive observer waiting for problems to appear. And the sellers who find themselves back on the market after a collapsed escrow, relisting a home that now has a stigma attached to it, starting the clock over, explaining to future buyers why their last deal fell apart, those sellers almost always had one or more of these three variables show up and manage unexpected. So here's the bottom line. If you're thinking about selling your home in Santa Clarita Valley, Antelope Valley, or Los Angeles area, the question is not just whether you can find a buyer. In most markets, with the right pricing and preparation, of course you can. The question is whether you can get the buyer all the way to the closing table. And in 2026, getting to the closing table requires understanding and proactively managing forces that did not exist at this level 3 or 4 years ago. That's exactly what I do for every single seller I represent. We address the insurance question before listing. We price what the appraisal data can support, not just what the buyer might agree to an emotional moment. And we manage the escrow timeline with discipline that this market demands. If you're thinking about selling and you want to understand exactly what your specific home looks like against each of these variables and what the insurance landscape, if you're thinking about selling and you want to understand exactly what your specific home looks like against each of these variables, what the insurance landscape is for your property, where the appraisal